Hey, everybody. Thank you for joining. I know a lot of folks are kind of coming in from the little waiting room situation that Zoom has. We are going to give it another minute or two just to let folks finish up with their previous meeting or grabbing some coffee or whatever have you. Um, yeah, we will kick things off in just a couple minutes. Till then, hang tight and thanks again for being here.
Morning, everyone. Thanks for coming. A lot of Texas representation in the chat this morning. We'll have to see that. Be heading there in a few weeks for TAA conference. Hopefully see some of you guys there.
All right, so we're 2 minutes past the hour. I think we can get started. Thanks again, everybody, for joining us. We see a lot of people introducing themselves in the chat. Seems like we're represented across the country right now, which is always great to see. Um, for those of you who are unfamiliar with our faces, my name is Rob. I am a member of the economics team here at Apartment List. And in just a couple of minutes, we're going to be kicking it over to my colleague Chris, who is the senior economist here on the team. For the next half hour or so, Chris is going to be walking us through the latest data that we're seeing in the rental market as we kind of switch here between the slower winter season to the kind of busier summer season. We're in sort of that transition phase, and so we're starting to get a signal on sort of how the market is trending so far this year. So yeah, I'll be here on the sidelines, kind of following along in the chat. If you have any questions, feel free to drop them in the chat or like the QA window. I'll do my best to kind of respond to those on the fly. And for the bigger questions or for things specifically for Chris, we'll hold those to the end and do a little Q&A session after. But yeah, with that, thanks again for joining us. I'm going to go on mute and kick it over to Chris to kind of get us started. And yeah, I hope everyone enjoys the presentation.
Awesome. Thanks for that intro, Rob. And thanks again to you all for taking some time out of your days to go over some rental market data with us. Rob said, I hope you all had a chance to grab your coffee before we get kicked off here, because I got a lot of content to run through in a short amount of time. So I hope that I'm not going to kind of open up too big of a fire hose here in terms of throwing a bunch of data points at you. But I'm going to go ahead and jump right into it. Our presentation today is going to be broken up into three sections. First off, I'm going to run through some of the key indicators, the stats on the rental market that our team is keeping track of on a month-to-month, week-to-week basis, and just see where things are at today. Then we're going to dig into some renter search behavior patterns, analyze some of this really rich data that we get from the Apartment List platform, from all of the searches that take place within our marketplace. And then finally, I'm going to spend a little bit of time talking about migration trends. We recently released our latest renter migration report, and I think that's a really interesting one to delve into a little bit. So we'll kick off here with key rental market indicators, and I'm going to start off here with rent growth numbers. So I always like to start off looking at rent growth. If you think about kind of the simplest Econ 101 framework, price is the variable that helps to keep supply and demand in balance. You know, when you've got more supply than you have demand, then prices will tend to fall, and then vice versa. When you've got more demand than you have supply, prices tend to increase. And so price is really the single best indicator that we have of where the equilibrium in the market is sitting at any given time. So where are we at right now? Right now, as of our latest data release, we saw rents increase by 0.6 month over month in March. That was the second straight monthly increase following 6 months of month over month declines. It is typical that we see rents dip a little bit in the fall and winter months during that off season for rental market activity. But we have been seeing over these past couple of years these declines come in a bit stronger than the increases that we're seeing in the spring and summer. So for full year 2024, we actually saw rent prices dip overall. Our year over year rent growth number is right now at minus 0.4%, meaning that the national median rent today slightly cheaper than it was 1 year ago. That 0.4% decline, very, very modest decline, but it's still notable to see prices actually falling in nominal terms here. It's not something that happens very often, but we have been in this period of declining rents since mid 2023. After that period of skyrocketing rent growth that we saw in 2021 and 2022, things cooled off pretty precipitously, and now we've actually seen prices falling. A lot of that really due to this influx of new rental supply that we've seen over the past few years. I'll say a little bit more about that in a couple of slides. But the thing I'll call out here is that this number has actually been gradually increasing over the past few months. From last October, our year-over-year number was at minus 0.8%, now at minus 0.4%. So we're getting closer and closer to zero here, and it does look like a return to positive year-over-year rent growth could actually be on the horizon now after really a pretty prolonged period of seeing prices dip. Now, here's what that looks like in terms of just the actual dollar value of the national median rent. Currently at a little under 1,400. That is, again, starting to tick up as we're kind of getting out of the slow season and rental market activity demand is starting to pick back up as we enter the spring. But you'll notice here that, again, this is kind of a different view for this long-term trend of, we had kind of pre-pandemic, this slow, steady increase in the national median rent, followed by a little bit of a cool off, and then a skyrocketing increase in the early pandemic. But now we've been sort of gradually trending down. The national median rent currently about 4% below its peak, which occurred in summer of 2022. Still about 20% higher than we were at the start of 2021. So we haven't seen this recent cool off. It's certainly not amounting to any sort of reversal on the skyrocketing growth that we saw a couple of years ago, but things have definitely cooled off from that peak a little bit. Okay, and of course, the important thing that I always like to call out here is that, those national numbers are really give us kind of a good view of what's happening big picture, but underlying that, there's always a ton of regional variation. So this map here is showing the current year-over-year rent growth numbers for every metro in the country that we have data for. And you can see there's some pretty clear geographic patterns here. A lot of those blue declining rents happening in the South, Texas and Florida in particular, markets in those states seeing some of the sharpest declines right now, while in contrast, the Northeast and the Midwest continuing to see positive rent growth. It's actually the case right now that out of the 100 largest cities in the US, 59 of those cities are seeing rents increase year over year. So even though our national rent index is still negative, a majority of large cities are actually have kind of turned the corner and are seeing rents increase right now. That decline in our national index is really because that national number is getting dragged down by some pretty substantial decreases in some of the larger Sunbelt markets. Austin, Texas, kind of the foremost example there. Rents in Austin down 6% year over year. Denver down 5%. Raleigh, Salt Lake City, Dallas, all down around 3%. So we are still seeing, pretty substantial declines in a lot of these Sunbelt markets. But a lot of other parts of the country have turned to the corners and are seeing rents increase right now. So I'm not gonna go super deep on many more of the individual markets here, but we do have kind of all of that data on our blog. We don't have time to get into every individual market, but folks that are interested, if I haven't kind of called out your market specifically in this map, feel free to please check out all of the data that we have on our site or reach out to our team. We're always happy to answer any questions that you might have. So shifting gears a little bit from rent growth to the supply side of the market, this is our national vacancy index. And this is something that kind of moves in tandem with rent growth. It tends to be the case that when rents are increasing really quickly, that happens because there is a real tightness in availability. That's what we saw in 2021 when our vacancy index bottomed out at under 4%. But since then, as the market has cooled off, this has been increasing uh, pretty consistently, and we have now hit a national vacancy rate of 6.9%, which is actually the highest that we've ever seen in this index, which goes back to 2017. So the previous peak was 6.8% that we hit in the early pandemic disruption period. Right now, we're at 6.9. The 2019 average, for comparison of kind of a baseline during a period of market equilibrium, was at 6.2%. So we're a little bit above that, and this has been continuing to gradually increase. Those increases have been flattening out, so we may be getting close to the peak here, but this has now been 3.5 years of vacancies gradually opening up. A lot of that has been due to this really big influx that we've seen in new supply. This chart now is showing the national multifamily construction pipeline, the number of multifamily units under construction on a monthly basis, going all the way back to 1990. You can see that actually peaked last year at over 1 million units in the construction pipeline. That was an all-time high. But now that number has been starting to come down. So 2024 actually saw the most new multifamily units complete construction in any year going back to the 1980s. We had over 600,000 multifamily units hit the market last year. But now that has started to come past the peak, particularly as permitting activity has really slowed down. The number of projects completing construction has started to exceed the number of new projects getting underway. And so we're working through this construction pipeline. The number of units under construction has fallen from 1 million down to 750,000. 750,000 units under construction nationwide. That is still quite a lot. If you look back historically, this 750,000, if we go prior to this recent peak, that's far more than we've had in any year going back to 1990 here. So we do still have a relatively robust pipeline of units to work through this year. We are still expecting to see a lot of new multifamily construction hit the market this year, but it is going to be down from last year's peak. The other thing I'll call out here too is, I'm sure we've all seen a lot of news about tariffs recently. That's kind of the big X factor that could sort of throw a wrench into construction pipelines. I think it's a little bit too soon to say exactly how that's going to play out. But if anything, I would expect that to have potentially a downward impact on the number of new apartment deliveries that we would expect to see going forward, given that a lot of construction materials are now subject to new tariffs potentially. Okay, so I'm going to shift gears now and say a little bit about what we're seeing on the renter side of the market based on some of the search patterns that we observe on our platform. So apartment lists, as I'm sure you all are familiar with. We have a really detailed quiz that folks go through when they register for our product that allows us to get to know our renters really well from the standpoint of our product. That helps us make really good matches. It helps us send you all really good leads, and it helps us send renters to properties that are going to match exactly what they're looking for. But from my perspective as a researcher, that gives us really good data to tell us something else about what's going on in the market based on what we're seeing in terms of renter behavior. So what I've got up right now is a screenshot of one of the questions that we ask folks when they register for our product, which is how important their move-in date is to them. And that ranges from a scale from 1 to 4, 1 being, I'm just sort of browsing. I don't necessarily have a hard move-in date, to 4, my move-in date is really important. It's set in stone, and I got to find a place. And so we use the answers to this question as an indicator of the urgency with which renters are conducting their apartment searches. So this chart is showing the breakdown to those responses bucketed into two groups. Again, that question, the answers are on a scale of 1 to 4. We bucket the two higher urgency and the two lower urgency responses to bucket this into just two groupings here that we refer to as high urgency, the purple line here, and low urgency being the blue line here. You can see we see some pretty clear seasonal swings in this data, as we do in just about every indicator that we look at for the rental market, where urgency tends to be higher in the summer peak season and tends to be lower in the winter off season. And we are starting to see that shift right now, where over the past few months, we've seen the share of users searching with low urgency decreasing, the share searching with high urgency increasing. I would expect that trend to continue over the next few months as we get further into peak activity. But the other thing that I would call out is that even though we are seeing a bit of a pickup in urgency, we are still seeing urgency look a lot softer than it has in prior years. For this time of year, at March of any given year, right now we're at over half of users searching with low urgency. If you look back at some of these prior years, it's been closer to 50-50, or in some years we've seen high urgency searches outpacing low urgency searches at this time of year. So even though these lines have started to converge, we are coming off of a record high share of low urgency, and I think we're still seeing less urgency than we would typically expect to see at this time of year. I think a lot of that does have to do with some of this supply story that we've been telling, where because of all the new supply hitting the market, renters just have a lot of options. I think renters are aware of that, and they're taking their time in their apartment searches. We see that also play out in our time on market data. So this data is actually going back to kind of some property side metrics here, where we're looking for all of the units that we observe on our platform. How long is it taking for those units to get leased? This metric is showing in any given month for the units that got leased in that month, how long had they been sitting from the time that we first saw them come available? And you can see, again, those clear seasonal swings, but if you look beyond just the seasonal pattern, you can see that time on market has been gradually increasing over these past few years. As of March, we saw units taking 34 days from the time that they initially were listed as available to the day that they initially got till the day that they eventually got leased. That came down a little bit from the peak that we saw in January, but this was still the longest list to lease time for any March going back to 2019, which is as far back as we have this data. So I think these two, when you look at this urgency data, this time on market data, I think it's telling the same story, which is that, renters are taking their time weighing their options. They're seeing that There's rents in many markets declining right now, concessions more available than they have been in some time. And so renters are able to kind of shop around a little bit more. We're seeing that play out in their search behavior. The other thing that I think could be playing into this is that, we are seeing a lot of broader uncertainty about the macroeconomic situation right now. That's playing out in a lot of consumer sentiment numbers that you see. And so during periods of economic uncertainty, certainly in periods of recession, but even in times where, where maybe we aren't in a recession, but people fear that they're not sure how things are going to play out over the coming year, that's when we tend to see a little bit slower moving activity. Folks just tend to be during periods of uncertainty a little bit more cautious about making big moves in terms of, well, big moves, I guess, in terms of just general consumer behavior. In this sense, big moves meaning literally willing to kind of move into a new place. That's obviously one of the bigger kind of economic choices that folks can make. And so some folks may be delaying that right now just because of the uncertain economic picture. The other thing that I think is really interesting to call out, though, in terms of our renter behavior that we observe on our platform, is that we had seen in 2024 a real decline in renter budgets. That was following a few years of budgets gradually increasing. Last year we saw that dip quite a bit. I think part of that due to the fact that, again, in many markets, rents were falling. So I think some of this is just renters being aware of what's happening in the market, seeing those concessions and falling rents and thinking, maybe I don't need to have as high of a budget as I did a year ago. Some of that, I think, also, though, due to coming off of this period of high inflation where folks are getting their budgets eroded in other realms, and so having less to be able to put towards their housing, both of those factors contributing to falling renter budgets. But now what we've seen over the past few months is that has started to rebound a little bit. So this is actually maybe, one thing where we're seeing a little bit of a conflicting signal of folks actually increasing their housing budgets during this period where we are starting to see a little bit of economic uncertainty. It might be the case that that uncertainty just hasn't quite filtered through to this budget data yet. I'll be really curious to keep a close eye on this and see how this evolves over the next few months as we get further into peak season, because I think some of this is also just seasonality. We do tend to see, during those periods of higher activity, more competition. We would expect to see a little bit higher budget, and so that is partially, I think, what's driving this increase, but it will be interesting to see how that plays out going forward. Okay, so now I'm going to quickly go into our last section here on migration patterns, and then we'll leave a few minutes for Q&A at the end. As I mentioned, our team recently put out our latest renter migration report. This map is one of the headline maps from that report where I'm showing here net domestic migration on a state level. So net domestic migration basically means what is the total population change for a state when you balance out the folks that left the state with the new folks that moved into the state, taking into account only folks that are moving within the country. So this is not accounting for international immigration. I'm showing this here on a percentage basis. And so you can see on a percentage basis, South Carolina was actually the fastest growing state. It saw an increase in its population of 1.3% due to net domestic migration. A lot of the Sun Belt markets and the Mountain West are the markets that are seeing the fastest growth right now, whereas the Northeast and the coast are actually seeing population declines right now in terms of net domestic migration. If we looked at this on an absolute basis, California and New York are losing the most people by far, whereas Texas and Florida are gaining the most in terms of just absolute numbers on a percentage basis. The Carolinas seeing some of the biggest increases right now. I think, one of the important things that I think is important to call out in these charts is that, these Sunbelt markets, we've been talking a lot about rents falling in a lot of these Sunbelt markets because we've had so much new supply hitting the market and that supply has been outpacing demand. But it is still the case that, it's not that demand has really kind of dropped off in these markets. We're still seeing a ton of people flow into these Sunbelt states. It's just that, we really have seen an overwhelming amount of supply in some of these markets. And so I think it's important to keep in mind that, these Sunbelt states are still popular, lots of folks moving there. And I think the long-term fundamentals for the rental market in those states is generally strong. It's just the fact that, we've been seeing really a historic amount of new supply hitting the market in a lot of these metros, and that isn't going to be indefinite. We're already kind of past the peak of that, and so I think longer term we are going to see those markets sort of balance out, even though we have seen in some cases some fairly substantial rent declines in recent years. The other thing that I think is really important to call out is that we're actually seeing a bit of a decline in just this long distance moving activity overall. So this is showing the share of apartmentless users that are looking to move to a new metro or to a new state. And after the pandemic shakeups that we saw in 2021 and 2022, we've seen both of these numbers start to come down off of those peaks. Some of that I think is related to the remote work picture starting to kind of balance itself out a little bit. A lot of those remote work moves that we saw a couple of years ago have started to settle down. We have seen some return to office mandates, and so some of these long distance moves are starting to cool off. And then the last thing I would call out is just that, we have a ton of great localized data in the interactive map that is part of this report. So I encourage folks to go check this out. This is just a screenshot of what's going on in Charleston, South Carolina. We see really strong inbound demand coming particularly from the North Carolina markets, but really from all around the country. This validates how the search activity that we're seeing on our platform kind of confirms what we see in publicly available data sources and maybe gives a little bit of a leading indicator on that. Again, I don't have time to get into every single market here, but I really encourage folks to check out the interactive tool that we have on the blog for this because it'll tell you a lot about what's happening in your market. So I'm gonna leave it there. This slide kind of summarizes a few of the key points that we talked about, but I think we have probably a couple minutes left for one or two questions. So, Rob, yeah, what's going on in the chat there? Anything that would be good to touch on?
Hey, Chris. Yeah, thanks for all that. A lot of good representation across the country here today, and interest in some of our more localized data. So excited to get to share that later. One general question is like, just based on what you're seeing right now, would you say that you feel like the rental market is off to a stronger start today than it was, say, at this point last year or the year before, which I think were kind of unanimously felt to be relatively slow seasons?
Yeah, that's a really good question. I would say, I'm going to go back to this month over month rent growth chart for 1 second. So you can see here, if we compare the first 3 months of 2025 to the first 3 months of 2024, it's fairly similar, but a little bit stronger is sort of how I would characterize it. Less of a decline in January, a little bit stronger growth in February and March. And that's same I can relative to 2023, kind of same thing. We're a little bit stronger than we were then. And that's what's contributed to our year over year rent growth number starting to inch closer to zero. That's because these first few months of the year have been a little bit stronger than what we saw in the first few months of 2024. But I think these next couple months coming up, that's really going to be I think really decide what this year is looking like overall. Because you can see Last year, actually, we got off to a decent start. You know, we had pretty strong rent growth in March of 2024, but then things really stalled out in April and May and June, the months where normally that's kind of peak activity, where we're seeing in a typical year, those kind of late spring, early summer months are when we see the fastest rent growth of the year. Last year, we actually saw rent growth stall out and even start to dip a little bit. And so I think, it remains to be seen, or is that what's going to happen again this year? Or are we going to see rent growth continue to strengthen over these next few months? I think there's a lot of uncertainty right now, again, just because of what's happening in the broader macro economy right now, that, I think things are probably a little bit more uncertain right now than they have been in some time. And it's not immediately clear how that's going to factor into rental demand as we head into peak season. But so far this year, I would say that we are off to a little bit of a stronger start than we were last year.
Thanks. And yeah, there's always the follow-up question is what are the tariffs going to do? And I don't think we're going to pretend to know any better than anybody else exactly what's going to happen there.
Yeah, yeah.
But
I mean,
you did touch on that, probably creating some headwinds for the rental market. But I think it's safe to say the level of uncertainty there is greater than the level of clarity. So with that, we are at 10:31. I want to be mindful of everyone's time. So if you're still with us, we appreciate you sticking around for the last 2 minutes. As I mentioned in the chat, a recording of this will be sent out to everybody who registered. So you'll have that in your inbox here in a couple days. And yeah, as Chris has put up on the screen, here are some links to reach out to us if you have any follow-up questions. But with that, Chris, I want to say thank you one more time. And to everybody here, thank you again for joining us. And we hope to see you again at the next one.
thanks, everyone.
Take care.
Bye.